Hi everybody, I'm Lorenzo Poeti from the investment team. I'm here to quickly review what happened during this first part of the year, and that was indeed another very good period for financial markets that continued to recover from the pandemic. The economic situation improved, and the health situation improved as well, and this pushed the markets higher. The big debate actually was on inflation because we are getting the highest reading in inflation data in many years, during which the main problem was actually deflation, not inflation, meaning price increase being too low. And why are we getting this inflation data? Well, mainly because companies have to have higher costs in producing goods due to the higher transportation costs, higher commodity costs, that are mainly due to the disruption caused by the pandemic. And this comes in a period where demand is going to increase a lot because of the reopening of the economy. How are central banks going to react to this higher inflation data? You know that when inflation is higher, usually central banks do hike interest rates, and in this way they slow down the economy and they slow down price dynamics as well. But this time, this won't be the case. They already said that they believe that this inflation will be transitory. They believe that the long-term forces still tend to push prices down, and these forces are, for example, technological innovation or aging population. So they will not overreact. They will not hike interest rate. And for the time being, it seems that investors do believe to central banks, and they think that inflation will be a transitory phenomenon. The other big point was when central banks were going to start to normalize their policies, because you know that economy is improving, but central banks and governments are still using emergency measures. They think that doing too little now is worse than doing too much. So they're still using emergency measures. So the big news of the last few weeks was the US central banks, the Federal Reserve, saying that they're going to look at data more carefully, and if the economic data, continue to improve, they could start to normalize their policies, meaning, for example, reducing their treasury bond buyings. There was a fear that when central banks would have started to normalize their policies, market would have taken this badly. But for the time being, this is not the case. Investors still believe that central banks will remain supportive of markets. So what to expect for the next few months? Should we expect to market to continue to go higher with no volatility, no corrections as they did during the last few months? Probably not. The summer is the more volatile period of the year and traditionally the weakest one. So we have to expect some volatility, even if the economy will continue probably to improve and central banks and government will stay supportive. But still, some volatility has to be expected. So what is our advice? As always, our advice is to stick to your plan and to invest for the long term, and don't be scared by some volatility that we might see during the summer. From us, enjoy your summer, stay tuned, and speak soon.